We move on, get the perspective at least of Anthony DePaul, the Senior Private Advisor at Atlantic Pacific Securities. He's live in our Sydney CBD studio. APA, I know you've been across this one though, perhaps with more interest. Can you hear me on that one? APO rather. Let's talk to APO.
Yes, so APO, well, it's certainly had a good run over the last 12 months, and it's a lot of that's on the back of a very healthy growth in outdoor advertising revenues. And 20% year on year. It surprised a lot of the market, and a lot of that's due to the emergence of the outdoor digital revenue space, which is really putting APO in a very comfortable position.
They do talk though about a number of site-specific deliverables being met. So they make acquisition in this respect over metro space, but there's still a caveat over what comes next, right? These sites promise one thing. The reality, is it always matched in that sense by what's promised?
Well, it is, because by going into digital, they're essentially they're increasing their total addressable, their total market share that they're addressing now is much larger, because they're starting to compete with televisions. So previously they were just in static, and that's only 5% of total advertising spend. But by now, they're going to be attracting more customers. If you have a look at the growth of that business over the last 12 months, what they're doing is they're buying static billboards at static billboard prices, and then with a very low cost of conversion, and you only have to look at how far plasma TV prices have gone down over the last few years to get a picture of that. That's really helped them to convert into digital at a very low cost. And then from a revenue front, they're getting an increase in yield in that area by attracting more customers, and also doing things like time of day advertising, which is really helping to increase demand for their service.
Do you see the run-up in shares though, Anthony? Now we're just showing the chart there, from a low point of 291 August of last year up to, well, today's actually a yearly high at 8.4. That's been much more volatile than the O-Media move. If you wanted to put a similar proposition, then alongside OML, the ticker code there. Okay, I mean, both have been through the ringers, and it's a cyclical play. I appreciate that, but I mean, in terms of expensive v fair value, which looks better?
Well, we prefer APO because they've got about 28% market share, and they are a big player with O-Media, but they've still got a lot of their static billboards yet to be converted. Their digital revenue is only about 25% of their overall revenue, so there's still a lot of conversions yet to take place. And when we look at valuations, well, you could say that, price-wise it looks expensive, but 20% revenue growth plus margin expansion of 18% up to 24% over the year, reflecting that increasing yield they're getting from digital, would mean that based on 2017 earnings, there'll be less than 20 times multiples. And if you compare that to a lot of high growth names like REA, if you're a high growth fund manager looking to put your money somewhere, this would be at a discount to those other high growth names.
When do you kind of reach a saturation point though? I mean, what takes you then to the next level? You're talking about even the unconverted sites. I mean, one assumes that those are even potentially still as valuable when converted as they might once have been. I know that might sound counterintuitive, but we can't always assume one location retains its gold star status.
Well, they've just recently, when we're talking about reading maturity, they've just recently increased their sites by about 200 with a couple of recent acquisitions. So there's still a lot more sites yet to be converted. And when you look at the greater awareness of the benefits of outdoor digital advertising, that will potentially move a lot of people away from TV to outdoor digital. And I still think there's a number of years to go before they reach that maturity. And during that time, providing they maintain that very healthy growth, and it's all within their control. It's nothing too unrealistic to achieve. When you look at those earnings in the out years and you compare them to its price, we feel it's quite cheap relative to the next 2, 3, 4 year outlook.
Tricky to track though, isn't it? From an ads sell perspective, how do you win over with the argument? I mean, you'd have to be saying we're getting this much traffic passing in any given average across the week or the month or the quarter, but that's not synonymous with they look up and they register and they make a click on it, because by definition they're doing other things, they're driving.
Yeah, that's right. Well, the time of day advertising is really important. Obviously, just like television, and they've got methods to be able to provide some sort of subjective measure on that. But it seems to be working. Like the customers like it, and you only have to look at the growth they're getting in their revenues to see that the metrics they are using seems to be working. And they're going not only in the outdoor digital space, but if you have a look at some of the railways now, you've got the digital advertising there. If you look at the Sydney airport, the Auckland airport, so it's not just the one channel. So they really are getting themselves a large footprint in 2 or 3 channels, and then with the greater awareness of the benefits of the digital space, that should be really supportive of the earnings with the metrics they are using.
Let's switch talk Henderson briefly. Rallying again today. HGG ran really well yesterday, ahead of the numbers that dropped just on market close. Then in London, investors picked up that baton and ran with it still. Some of the lead remarks from CEO Andrew Formica are institutional flows turned positive in Q2 with a positive pipeline. And that's, admittedly though, your margin's plumper on the retail side of the divide, right? But just put it into context.
Yeah, I agree. So I think Henderson would have probably skipped a heartbeat over the last month, and they would have been extremely worried immediately after the Brexit, especially with the net outflows we saw in the retail space. And luckily for them, as the confidence in the market was restored with the central banks coming in and providing some very soothing comments to the market, the hemorrhage they were getting in the net outflows in the retail space started to ease up a little bit. But I don't think the worst is over, and it really, over the next 6 to 12 months, I think there's some nervous Nellies in the behind the scenes in that company, because if you have a look at the 50% assets under management is mainly compromised with the retail space. You alluded to before that nearly approximately double the management and performance fees are approximately double that in the retail space compared to institutional. If fear starts to creep in as some of that UK economic data starts to come out, you're going to get that second wind of net outflows, and that can have a dramatic impact to their next 12-month outlook. And I still don't like the look of that stock in the medium term. Are you
preferring, for instance, a Clydesdale simply because it's quarantined to UK ops? It's got its footprint's more easy, I suppose, to navigate than the unknowns of a European spillover as well?
Well, I prefer neither, because if you have a look at UK property, you've got 50. Well, at the moment, the redemption for the property funds are mainly based due to a request to reallocate capital. It's not that the customers actually need that capital, but the moment you've got an increase in unemployment or a recession starts to creep in, they actually need that capital, and that could, if there's any redemption requests in that situation, could really start to hurt the economy. And if you have a look at the banks, 55% of the banks' loans are backed by commercial property. If you have a look at small business loans, 75% are backed by property. So if we get a dive in the property market, not only is it going to hurt Clydesdale, but it's also going to hurt Henderson, because you're going to have a global or certainly a European liquidity freeze. You're going to have an increase in the cost of capital, and that's going to hurt equity markets, and it's going to hurt the banks in that region.
Well, that said,
Henderson
you're
did
pricing an
say-
Armageddon, right? Which, I mean, that we are some way from that prospect.
Well, you know, when we talk about the equity markets investing ahead of the curve, it's really important to get involved ahead of the event. And you know, if you Henderson were helped by some of their fixed interest products doing well in the last quarter, especially in the Australian region and the US region. We had an increase in flows from their institutional part of their business, which helped marginally offset some of the outflows from the retail equity portion. So, but I don't think that will be enough to save them in the event that we have more volatility and fear creeping into the UK and European equity markets.
Let's hope it doesn't descend into that kind of, well, malaise that you project. Anthony, thank you so much. Appreciate it.
Thank you.
Anthony DePaul, Atlantic Pacific Securities.